Hello and good afternoon. This is Amy Bohr from the Mortgage Collaborative. Thank you for joining us today. This is our TMC Connect webinar overlays and best practices, credit qualifying borrowers getting back to work. We're just going to let some attendees filter in here for about 30 seconds and then we'll get started. All right, so thanks for joining us this afternoon. As I said, this is our overlays and best practices, credit qualifying borrowers getting back to work webinar. This is part of our TMC Connect education platform where we do plenty of webinars just like this. We have surveyed our lender member base and we have gotten great responses on what you want to hear about. This was actually the #1 topic that our lender members wanted us to discuss, all of the overlays and with everything going on surrounding borrowers returning to work. Real quick though, we also have our dedicated lender-only message board, asktmc.com. You can access it at ask-tmc.com. We also cross-post on LinkedIn and Facebook, so you can go on there and post any questions you may have. It'll go out to our member base. Or you can go on and you can answer any questions that you see our members have put on there as well. And then we also have our TMC Benchmark, which is a data benchmarking tool that is part of our membership as well. So I will get into keeping items. This call is recorded. It'll be distributed to all registrants tomorrow. And then also, all the lines are muted, but if you have any questions, we certainly want to be an active call. So please put them in the chat. You can use the Q&A function. We won't wait till the end of the call. We will pose the questions to our panelists immediately as they come in or right as they come into the chat or the Q&A. So without further ado, we have an awesome panel today. I'm going to go ahead and let them introduce themselves, but Tony Butler, we will start with you. Tell us a little bit about your role and your organization, please.
Tony Butler here. We're out of Columbus, Ohio. I've been a member for 3 years now, and I am the president here. We're doing right around 40 million a month. Recently switched from hedge to best efforts, so now we're working with many guidelines, not just one. So it's been fun. And just trying to give back a little bit to Mortgage Collaborative for all it's given us.
We appreciate that so much. I mean, having you guys as discussion leaders during the end of the month and a super, super busy time is like beyond, we're beyond appreciative of that. So Kathy Horn, can you tell us a little bit about your role at First Community Mortgage?
Sure. I have been with First Community Mortgage for about 8 years. And I started out in underwriting and then went to underwriting management and then moved to the production support role where basically I manage all of the credit guidelines and all of the updates and bulletins, product development, work on that. I've basically in my career with mortgages have done everything on the front end from processing, loan origination, underwriting. So I have an appreciation for the sales side also, not just the credit side, but love what I do, just trying to keep up with all the changes.
Aren't we all? And last but not least, Kim Nelson from Bank South Mortgage. Kim, thanks for joining us today.
Okay, great. Thanks for having me. My name is Kim Nelson and I am the CEO of Bank South Mortgage. We're a Georgia-based company. We are wholly owned by Bank South, and it's hard to say what we will close this year, but historically we've been about $1.3 billion in annual production. We are currently closing, $170 million a month. So we've had to scale up with existing teams, which has been difficult and trying at times. And we're currently selling everything pretty much to Fannie and Freddie direct, And that's about it.
Thanks. So I will move along, here, and go over real quick the topics of discussion that we're going to cover today. We'll talk about overlays related to our base salaried only borrower, base hourly only, and then self-employed. Then we go to the always fun overtime commission bonus and tip calculations and qualifying income for that. Changes with day one certainty and the impact that's had, as well as any other overlays that are related to the current climate, which, as we know, is constantly changing. So as we jump into this slide, Kim, I'm going to start with you because you've provided me with a bunch of information in advance of this call and resources from Bank South Mortgage on borrowers returning to work and the businesses reopening. This was super helpful to me in the preparation of this call. Can you give us some insight on the process? Who's making the decisions at your organization, determining the overlays, and how those updates and overlays are being communicated to your ops staff, as well as sales, I guess?
Okay. So, our SVP of operations pretty much initiates everything. And we also have a risk committee where we're reviewing big changes, talking about overlays, approving to pivot, back to normal somewhat. I know that we're talking to people that are in different parts of the country, but Georgia might be doing a little bit better on the economy front than, say, a company in New Jersey. So we're on calls every week. We started out with management calls daily. We went to 3 times a week about April 12th, and then 2 times a week around May 18th. And as the changes come through, the guideline changes come through, if we start to see a spike in forbearances in Georgia, not necessarily just with Bank South Mortgage, but just trying to pay attention to what's going on out there. Or if the headlines read that Wellstar has laid off 100 people in Georgia, or Delta has furloughed a portion of their 33,000 employees in Atlanta. Just we're just all in it together, and I think communication is key, and we're pivoting and making changes pretty quickly. And
yeah, it seems like you've got some really great guidance out there with sending the guidelines, and you've got some documents that you have the borrowers sign. So we'll get into that when we talk a little bit more about the salaried borrowers. Kathy, how about you? Are you integral in making the policy changes, the overlay changes, or you're working with risk at the same?
Right. I watch for all of the updates and guideline changes from all agencies. I also watch some of the aggregators that we sell to just for any of their overlays in addition to what has come out from the agencies. And then once I've had a chance to really review them, they kind of trickle in at different times. So I usually give it a day or so unless it's something hair on fire. And then I will collaborate with the chief risk officer and the COO, and we usually get on a call and discuss anything that is, for example, when Fannie and Freddie came out with their guidance of what they were going to allow for flexibilities, we got together to discuss it to decide what we wanted to allow. A good example would be some of the flexibilities that the government agencies allowed, we decided was outside of our risk tolerance. We want re-verifications of employment. We don't want to accept 2 months bank statements for 2 months reserves instead of verifying employment. So that would be something that we would discuss before we put something into place. And then once we decided on what our overlays are going to be or what our guidelines are going to be, I'll push that out in a bulletin to all of our divisions.
Awesome, thank you. Tony, you mentioned that you underwrite to your BE investor.
Yeah, we recently switched just with the fun that we had in the hedge world a couple months ago. We decided to take some risk off the table and mainly go best efforts. So really between myself, my COO, and my head of underwriting, we're kind of just playing it, trying to get it the best we can for a common guideline, but it's basically the investor's policy at the time of underwrite. And sometimes we have to underwrite them again because it's the policies are coming out effective immediately, not based on lock dates, which I've never seen until now. So that's been a challenge. Right. But yeah, it's continually fun. That's for sure.
Keeps you on your toes, right?
Absolutely.
So we'll jump into base salary. This is actually the guideline that Kim provided. It's in her return to work business reopening guidance. So base salary, they must provide updated pay stub based on the borrower's pay cycle, dependent on the borrower's pay structure and type of income, determine if paid weekly, semi-monthly, bi-weekly or monthly. In some instances, one pay stub after return will be sufficient. In others, it may take several depending on its salary or hourly employee. Pay stubs must indicate stable and consistent earnings since time of return to work. Is that similar, Kathy, to what you guys are doing?
We don't necessarily have a written policy per se for what we will and won't accept on base salary. It's really case by case. If you have a borrower that was laid off or furloughed and they've returned to work and they're back to 40 hours a week, and you can verify that through a full VOE or one pay stub, that would be great and acceptable. But if you have someone, that's a variable pay or variable hours, it really just depends on the case by case scenario. So we have our underwriters escalate it to their underwriting managers, and then the next escalation is to production support. So it comes to me and we'll take a look at it. And if we need to pull in risk, we'll pull in risk and make a decision, a business decision on it. But for the most part, for salaried, once they're back to work and earning full pay, it should be acceptable.
Mm-hmm. Do you take into consideration what their position is? I mean, I know
Absolutely.
obviously with hourly you do, that's different, commission hourly, but just a straight 40 hours, it would, yeah.
Some of it depends on what the job is and what the position is and the likelihood of them being able to continue doing their job in this environment. Salaried, we really have not run into a whole lot of issues with. So yeah, that one has kind of been the easier side.
Right. We get consistent, like as the deck goes on, we get a little bit more hairy in how we have to deal with things, right? So yeah, we'll hop down to, okay, we wanted to talk about the verification, the final VOEs too. Is that still, I mean, back when I was in ops, it was 10 days. Within 10 days, that's obviously changed for most.
We do within 3.
With 3 days, okay.
Preferably same day,
but 24-hour. Yeah, some were doing same day. I mean,
yeah, it's just too hard to make that a requirement. So 3 days is what we decided on.
3 days. Tony, depending on your investor, I guess.
Yeah, 3 days covers all of our investors. That's what we've moved to as well.
Okay. And Kim? Oh, you're on mute.
We started with 24 and we have gone to 2. And actually, we had a call today discussing whether or not we would move that to 3, just because it's causing some, problems moving loans through the system. But, if it's, an airline or a hospitality person or, obviously we're going to do same day. I mean, a lot of it is common sense.
Mm-hmm. Is there anything that happens again on the back end further down the line, like 3 months down the line, where because I recall hearing this back in my ops days as well, that there is another level of check after people close, after borrowers close, after the final VOE is completed.
Yes, we've had that happen, and we've had a loan pushed back before because someone lost their job the day after closing.
Right. Okay, so with our base hourly only borrowers now, those obviously are a little bit more tricky because they could have variable income, they could have reduced hours. How are you handling those borrowers, Kim?
So
Actually, it says
again,
right
it's
here, yeah, this is BSM. It's case by case.
right. Well, it's case by case, and it's, also common sense underwriting, just based on the line of work that they're in, or if it's tip income, and I know it's frustrating for the production teams, but I mean, it just has to be that way. And we are looking at overtime differently. We're looking at tip income differently. We're looking at bonus income differently for people who have been furloughed or are returning to work, or maybe even starting a new position, but same line of work, and we need some of that additional income.
Mhm. Kathy, before we went live on the call, we were talking, I mentioned blended income. Is that something that that you are allowing at this point? I mean, again, I know we're always going to talk on a case by case basis, but allowing, a history of a certain amount of income earnings with variable income to get the borrower to qualify.
Some of it's going to depend on the job. I mean, for example, a server, somebody that earns tip income along with a small hourly pay. Right now, it's a pretty tough time for them, and it's also depends on where they're located. For example, I'm in Louisville, Kentucky, and the restaurants were able to open up to a 30% capacity. Well, at 30%, you're not making the same amount of income in tips that you would have been if it was 100% capacity. Many servers aren't even going back to work because they're making more on unemployment than they were
Right.
prior to.
Right.
So it really comes down to what the job is, how long have they been back on the job, if they were furloughed or laid off. Can you tell based on how long they've been back and the income documentation that you have? Are they back to earning similar earnings? And if so, then we might allow that to close using that income to qualify. But it's just really diving a little bit further into those loans because there's obviously higher risk that they're not going to have a job for the continuance part.
Well, I imagine so much has to get escalated to management too
Yes.
now on these on these cases. I mean, before it used to be every once, a certain percentage of loans, and now the percentage of loans that need to be escalated is
It's really hard for
different.
underwriting because
Yeah.
it's just not black and white, and it never has
Right.
been. Anyone that's ever underwritten knows that it's not black and white, but
Right.
there's so much gray area right now that we just keep telling our underwriters, don't, if you're not sure, ask the question. Don't make a bad decision because you're in a rush. Take your
Right.
time and really think it through. So
Do you think, do you find your underwriters are being overly cautious, or, almost?
No, I mean, everyone has an underwriter that's way more conservative than the other underwriters, but for the most part, I think that we've given them a decent amount of tools and access for escalations that they're not afraid to reach out and ask. There's a lot of daily calls that they're having with their underwriting managers, going over things that they've seen, what has been approved, what has not been approved. And as things come up and change, we just make sure it's all about communication. You just have to keep in communication with underwriting staff so that they're aware of any changes and what can and can't go.
Well, let's talk about a little side conversation here, I guess, but how are the LOs? Are the LOs getting this information? How they're receiving it? Are they really adopting it? Are they understanding all of the overlays? I mean, we know sales is sales, but as far as just knowing what's a viable loan and what's not, Tony, what's your experience with that?
Much better than I had thought 60 days ago. I think because this is so big and it's so in front of everybody that everybody just understands there's landmines everywhere.
Right.
And we're a very high purchase shop. We're still running about 50% purchase, maybe 40% right now. But we're definitely scared of issuing a pre-approval letter and then having that seller have their stuff on the moving truck, and then here we go, right? So we're doing a really good job vetting that out. The refinances, I think it gets a little bit more, hey, if it happens, it happens. If it works, it works, and that kind of throws a wrench in things. But yeah, I've at least our salespeople, I'm surprised. Luckily, though, there's so much business out there that they can cherry pick right now.
Right.
And anything that does sound like a little, like a really high touch, deal, they kind of have the ability to punt on right now. So I think they're taking advantage of it.
Yeah, that's a really good point. Volume definitely drives the
quality
right now. The quality, yeah. It probably would be a much different situation if it was slim pickings out there. So we moved to self-employed, our favorite kind of borrower to underwrite. Lots of changes here, right? So, okay, taxes aren't due now until July. And so what are we, what are you requiring now as far as, opening back up of businesses, re-verifying that they are viable, making money? Kim, you had some notes on that with regard to what you guys are doing over there at Bank South.
Right, so we are looking at self-employed borrowers differently, and we have published some guidance there. And I also wanted to say, I think it's important to have weekly underwriting calls for the production teams and such, and they'll hear and learn, about all of the different guidelines and gotchas and that type of thing, and understand that they need to go above and beyond to document income. And when this first all happened, we immediately went to, all self-employment income has to be discounted 30%. I mean, that was just right out of the gate. We did that. And then, of course, we pulled back on it as time has gone along. And then we've looked at things on a case-by-case basis as well. And, you have to look at the type of business. Is it functional in a shelter-in-place world? Is it viable? Does the business support, the hospitality industry or whatever? So it definitely is, a case-by-case basis, and our loan officers are going above and beyond and getting letters from accountants and, addressing income decline deposits. We're asking for updated P&L. 2019 and 2020 year-to-date P&Ls are required, and we're also verifying that the business is still in operation and not just doing the Secretary of State thing, and following agency guidelines on that as well.
So what do they, if they're not accepting the Secretary of State printout to verify, what other ways are you verifying? I mean, invoices, I think I saw, or receipts.
Right, and we're also doing lender certifications, verifying that the business is open, and we've have also asked for letters from CPAs that the revenue and income and expenses are continuing at the same pace, that type of thing. Just it's certainly not for all self-employed borrowers, but
right,
depending on the type of business and such.
Kathy, anything in addition to that that you guys are doing to ensure that your self-employed borrowers, your income is continuing?
I mean, we've asked for business bank statements just to show that there's income coming in. We've asked for everything under the sun, really. I mean, this goes back to getting creative when you have a Schedule C borrower with no name of a business, that they don't file on Secretary of State. You have to get creative. They don't use a CPA, which CPAs very rarely want to write letters anymore anyway. You just have to get creative. I mean, we've used Facebook. We've had people drive out, and if it's local, to check to see if the business is open. Just try to get as creative as possible and make sure, and obviously it depends on what the business type is. If you know that they've been closed down because a hair salon hasn't been allowed to be open, You might would take a little bit more precaution on something like that than a realtor that's been booming in business and has been still making money. So it depends again on the type of business that it is.
Right. Yeah. Good point. So moving on now, we've got overtime, commission, bonus tips. We kind of talked about this already, but what else? So commission, is it still, I mean, I guess it's going to be similar to the self-employed borrower with what are you requiring with regards to, are you still requiring 2 years bank statement? I mean, sorry, tax returns? How are you qualifying on commission income?
We don't require tax returns on commission income anymore because they can't file 2106 unreimbursed expenses anymore. But again, it kind of depends on the business because
Right.
like auto sales, I think of them as commissioned employees. Well, no one's really been buying a lot of cars the last couple of months, but then I also look at it as once things start to trickle back and get to normal, they're going to be back where they were before. So
Right.
it's not really fair to a borrower to penalize them for COVID-19 timeframe. If they're back selling cars, using that as an example, and they can show that they've started to earn that income again, then I would take a little bit less conservative look at it and possibly use an average prior to COVID-19. It just depends on the business. We've run into something really weird that I guess I never really thought about it, but like USDA income limits. Think of the opposite side of things where what about the borrowers that are working for companies that have been working so much overtime to be able to keep up with demand of food? Procter & Gamble was one of them that we had, and they don't qualify because they're over the income limits. Again, not likely that something like that is going to continue. So is it fair to say they don't qualify because they're over the income limit? So you just really have to think.
Yeah, I mean, this just really changed so much with how the underwriting is just so specific. You can't blanket anything anymore. Same for you, Kim. Anything different with commission borrowers that beyond what Kathy has said?
No, pretty much the same. I mean, we would be looking at the line of work that they're in. We would require 30 days of pay stubs to, demonstrate some consistency in income. We would also look at their, cash reserves, and expect that those businesses will get back to normal at some point.
Mm-hmm.
So it's the overall credit risk of the borrower, not just, where's your commission today?
Right. Do you ever consider assets in lieu of income as well? If they have significant assets, but are not, say they're not making that commission anymore, they're not going forward, but they have a significant amount in assets? Has that become?
We would have to follow, agency guidelines with, for like an asset depletion loan or something like that. Not likely that we would.
Not just as a compensating factor or anything. Yeah. Okay. So yeah, we talked about tips too. So now we'll just go, there was day one certainty. Can you guys update me on what's going on with day one certainty as far as, I mean, I know it's still suspended, right? Is anybody?
Only the employment is suspended. Right. The income is still validated.
DOIs are, yeah. And so, Kim, you had mentioned that you're still seeing loans validating income, even though the VOE is currently suspended?
Yes, on the DU findings.
Okay. And then are you still using, I mean, obviously you're using like Work Number for your VVOEs too, right? You guys were talking about forbearance before the call. Kathy?
Yes.
Did you want to I just wanted to have that conversation with the attendees on the line as well, just stuff that you're waiting on and the challenges that you have come up. come across with that?
That's been our biggest challenge recently, the most recent, which is changing daily, but the most
Right.
recent nightmare has been forbearance. So glad that Fannie and Freddie and FHFA came out with the allowances or the flexibilities or rules that they have around people that have filed for forbearance, whether that's that they kept making their payments or whether they were actually late and they deferred their payments. Unfortunately, we're still waiting on government agencies and Jenny May to come out with the guidelines about how long, if you have to wait, once a borrower is out of forbearance, how long do you have to wait to be able to refinance them? But the other side of that is, you know, as a lender investor, you also want to make sure if the borrower went into forbearance, did they lose their income and were they up against a hardship, and do you want to refinance them at that time into a new loan? Or a borrower that's purchasing a new home that has forbearance or has gone into forbearance on their current home, you kind of have to look at everything to make sure the loan makes sense. A lot of people went into forbearance that didn't have a financial hardship, so those people can still make their mortgage payments, but we just don't have any guidance on government loans, and we've got a lot of people knocking at our door asking to refi, and we don't have anything to tell them right now. So it's going to come down to where we're going to have to make a business decision or have a discussion with, you know, our risk officer to see what we can do for these people.
Mhm. Tony, same in your camp, I'm assuming.
Yeah, I wish the guidance would have came sooner from FHFA, but we're welcome to have what we have. Our big thing is going back to all the income and the overlays and everything. I think the biggest thing is the file doesn't get, if you're selling to an aggregator like we are, right, your file is going to get examined when they request the forbearance, right? That's going to be requested. The file is going to be examined when they miss a payment. So the calculations you make on your self-employment and your commissioned and your people returning to work, just because you sell one loan with that calculation doesn't mean it's good. It has to be tested when they fully audit it. And I think as the forbearances go away and we get further away from the COVID issue, hopefully we do, right? And we get further away from forbearances and unemployment starts to get back to normal, I think all this stuff starts to fade away and hopefully be in this. We can put this in the history books for all of us, this event with all these questions, hopefully.
You mentioned unemployment, because I'm thinking now how, you know, when the servers go back to work, and you know, when I think of seasonal employees and how we factor in unemployment for those folks, is it going to be the same for the servers? Because they've been getting such a larger, or not such a, but a lot of them have been making more money than they normally would. Will you be factoring in the unemployment, you think, as well, or no?
No, absolutely not. The only way you can factor in that, in my opinion, the only way you can factor in the unemployment income is if it is seasonable, and you can show 2 years of history. So this, from all my guidance, is throw this out. This was a blip. I am really concerned. I've got a lot of friends that are restaurant owners, and here in Ohio, we were, I think, if not the first, the second, or the first to shut everybody down and send them home. Yep. So we're just now returning to work. We're seeing, you know, we're just seeing some restaurants not even choose to open, right? Their staff is, they either bring their staff back in, pay them nothing, or let them stay on unemployment. I mean, there's some tough decisions out there.
Yeah.
It's very interesting.
Yeah, and I mean, they're like Kim said, they're opening, but they're opening at 30%, or they're only doing outside seating. So that, yeah, you don't even need the full staff. And the ones that do come back wish they were still staying home because they're not making anywhere near what they were when they were home.
I had a long talk with one of my good clients. It's a dentist. His overhead has went up probably 20%. Just for all the protocol and the PPE and everything they need to do. So how reliable is the last 2 years of his practice on the income? Like, there's a lot, like 25% haircut on self-employment and commissions right now is probably the safest thing to do if you can qualify with that.
Right. Yeah, I mean, that actually goes for restaurants too. I mean, they're having to put, you know, distance everybody. Some are going to virtual menus versus the regular handout menus, being able to order just on, online from your server, different wine service is being done at the bar where it used to be done at your table, wearing masks. So there's additional costs associated, I guess, for every business that's going to reopen, right? I mean, across the board. So, well, we are pretty much at the end here. I do want to open it up to our attendees to see if anybody has any questions. We are a little bit shy of our 45-minute mark, but to your guys' point, it's the end of month, and I'm sure that you would love to have that 10 minutes back. So if any of our attendees has any questions, now's the time to put it in the chat. If you have any comments, something that you're doing at your organization you want to share with us, please let us know, chat or the Q&A. And guys, thank you again so much for, even giving me this 35 minutes and checking out the PowerPoint deck earlier today. Really appreciate it. For our attendees, Kim has she provided me with a guidelines and gotchas document, as well as two documents that they provide to their borrowers. Kim, did you want to talk real quick about that? The borrower mortgage liability acknowledgement and certification, as well as the employment and income acknowledgement. When do those get provided to the borrower?
Yes, well, so some of this went into place when, when all of this started. Pretty much, wanting borrowers to acknowledge that they are employed and acknowledge their income, and, basically that it's their intent to make their mortgage payment. I know that we can't discourage them, but, just asking them to validate that, yes, I'm employed. Yes, this is my income. Yes, that's my payment, and I understand or plan to make it. The other thing that we've had borrowers sign is the mortgage liability acknowledgement and certification. Basically, they're certifying that they do not have any mortgages in forbearance, have not requested forbearance, especially if some time has passed since we received their mortgage statement or that type of thing. But just having them acknowledge that at the closing table is important. I mean, they're sitting in front of an attorney at that point. And one of the other documents that we've had borrower sign is just a COVID-19 coronavirus employment and debt certification. Certifying that they have not opened any new credit, their employment and income is the same, certifying that their debts have not changed, their ability to repay is still the same as their initial loan application. And I know a lot of this is redundant and it might be in one document or another, but we feel like, having a borrower do that at the closing table. And we've yet to have a loan go into forbearance before the loan is sold. Wells Fargo was our largest aggregator prior to us everything to the agencies. We just received a report from Wells Fargo that we have not had one of the loans that we sell them go into forbearance, and they're actually discussing the fact that Bank South does not have any borrowers in forbearance. And in our servicing portfolio, our forbearance levels are half that of the nation of what's being reported, and more than half of those borrowers that have inquired or requested forbearance are actually making their payments. So, I do think just some of that validation, or at the closing table, or having the closing attorney ask those questions of the borrower, just adds credibility.
Mm-hmm.
Yeah, it's another level of confirmation, something that they need to sign. So to our attendees, Kim has been gracious enough to share these documents with us. I can certainly distribute them with the recording of this call tomorrow. It does not look like we've got any questions coming in. So I think what I will do is allow y'all to go back to your busy day. And I really do appreciate, like I said, appreciate the time, appreciate you guys doing the prep work prior to the call. And to the attendees, thanks again for joining. It's not lost on us how busy you all are as well. So really appreciate you registering and being on the call. And I will send out the recording tomorrow. Make sure you check out our lineup of TMC Connect calls for next week. And I will see you all soon. Stay safe,
Thank
everybody.
you.
Thank you.
Thank you.
Bye.
Thank you.